Hi guys and welcome back to the Mindful Investing channel. Today I want to talk with you about Tesla stock, ticker TSLA. As always, let's try to assess the returns a potential Tesla investment would offer us if we were to invest right now. To come up with those returns, we'll value Tesla using a simple discounted cash flow model. To be able to value Tesla using this simple DCF, we have to first make a couple of assumptions. First, we have to assume Tesla's free cash flow growth rates for the next 5 years and for the 5 years following those 5 years. Then we have to assume Tesla's price to free cash flow multiple at the end of our holding period, so basically in 10 years. Lastly, we have to assume Tesla's future annual buyback yield over our holding period. So let's begin with our assumptions for Tesla's free cash flow growth rates. Personally, I like to base my free cash flow growth rate assumptions on Tesla's historical free cash flow growth rates. When we look at Tesla's historical free cash flows, we see that Tesla has only been free cash flow positive since 2019. Therefore, we can only calculate Tesla's free cash flow growth rates based on those 3 years. When we do so, we come up with a 2-year compound annual growth rate for Tesla's free cash flows of 87.4%. Because it's easy to grow free cash flows from a low base, I only assumed a free cash flow growth rate for the next 5 years of 30% and for the 5 years following those 5 years of 30%. Even though those free cash flow growth rates aren't even half of the compound annual growth rate Tesla achieved based on the last 3 years, they will still result in Tesla's free cash flows increasing by almost 14 times. So they are by no means a conservative assumption. Next, we have to assume Tesla's price to free cash flow multiple at the end of our holding period, so basically in 10 years. Because Tesla is a great brand, I assumed the price to free cash flow multiple of 20. And yes, if Tesla would execute and grow their free cash flows by 30%, even in the second half of our holding period, a free cash flow multiple of 20 would be way too low. But I don't think that Tesla will be able to grow its free cash flows by 30% in the last years. Lastly, we have to assume Tesla's annual buyback yield over a holding period. Like with our growth rate assumptions, I like to base my buyback yield assumptions on Tesla's historical buyback yields. When we calculate Tesla's annual buyback yield based on the last 5 years, we come up with a buyback yield of positive 9.4%. So basically Tesla did not buy back any shares, but diluted their shareholders by 9.4% each year. To show how ridiculous Tesla's current valuation is, I only assumed a future dilution of 7% per year. Because we calculated Tesla's free cash flows to the whole company, which is usually funded by debt and equity, which bear different costs, we have to reflect those cost differences in our discount rate. To do so in our simplified DCF, we simply enter Tesla's current market cap, its interest-bearing debt, and its interest expenses. After doing so, we can now finally calculate the returns an investment in Tesla would offer us by simply adjusting our cost of equity until the number in the green box is equal to Tesla's current enterprise value per share. When we do so, we come up with a cost of equity, which is basically our internal rate of return over a holding period of 2.2% per year. So even though our assumptions are by no means conservative, even if Tesla were to execute on all our assumptions, an investment would only offer us 2% return per year. So for me, Tesla does not seem like an attractive investment because the risks definitely outweigh the potential returns. So that's it for today's video about Tesla. Please feel free to ask any questions in the comment section and leave a like if you enjoyed the video. Please always keep in mind to do your own due diligence, your own research, and to never simply trust a guy on the internet telling you that there might be a potential investment opportunity. See you next time.